Hi, welcome to another episode of the Get Ready with Tony Steuer podcast. Today, I am pleased to welcome David Paul, a founding member of Alirt Research. David, good morning. How are
Good
you?
morning. I'm fine. How about yourself?
Good. Thanks for coming on.
Oh,
Looking forward to our discussion today. Before we get started, I'm going to tell you a little bit about Dave. David has been with Alirt Research since 1999 and is a founding member. David's responsible for building out the company's life, property casualty, health, and international analytical models and services. David co-directs the company's research staff, manages internal IT initiatives and product development, pens a number of the firm's insurance industry research pieces, and is actively engaged in client service and development. David has over 25 years of experience in insurance research, financial analysis, and is active in the insurance industry as an author and public speaker. David, could you tell us a little bit about what Alirt Research is?
so Alirt Research, as you indicated, is a firm that analyzes the financial strength of insurance companies. The firm is owned by myself and my two partners who have worked together for approximately 30 years doing this type of work, analyzing the financial strength of insurance companies. We actually together worked for a firm that was a spinoff of Conning & Company, which is also a well-known Hartford-based research firm. So we're kind of part of that Hartford, Connecticut tradition of insurance research. We've had our company for 20 years now and have been able to grow it kind of exponentially since we started.
Well, that's exciting. And I know that Alirt Research takes a very unique way of looking at insurance companies in a very more advanced modeling of insurance companies. And we'll definitely get into that. Before we do, can you tell us a little bit about how you got started in this end of the business?
Yeah, like I said, I mean, so I'm somewhat unique, I think, in that I've kind of done this my whole career. I started, like I said, about 30 years ago. I did have a couple of jobs beforehand. I worked as a technical writer. I also I did some work in the workers' comp field for loss control, but really only for 2 or 3 years. And then I was invited to join the spinoff of Conning & Company, where I learned the business and kind of have been there since. So again, I've had the good fortune of working with my two partners for almost my whole career, and the second good fortune of owning our own business for the last 20.
Well, that's great. So let's talk a little bit more about what Alirt Research is. I think the first question is, what is the Alirt way, the core philosophy of your firm?
Yeah, that's a great question, and certainly, and we'll talk, I guess, at the end about how to get more information about us. But certainly on our website, if you look under the introductory material, you can see our conversation about the Alirt way. The Alirt way really is an expression of our philosophical approach to analyzing insurance companies. It's kind of a three-tenet approach, or a three-legged stool, we like to say. The first leg of that is that Alirt does all of its analytical work on insurance companies at the statutory or legal entity level. And as we'll, I think, talk a little bit later about, this is different from how rating agencies tend to approach the analysis of life insurance companies. So our work is what we call bottom up. That means that we are concentrating our analytical work at the level of the financials of the company that's on the declarations page of a policy, as opposed to kind of analyzing a parent and depending on the implicit support of that parent to support an underlying subsidiary if it gets into financial trouble. So I think that's very important, bottom-up approach versus top-down. The second leg is really that we believe that the analysis should be ongoing and as real-time as possible. So we update our models on a quarterly basis, which is obviously the best we can get using statutory and GAAP data. We believe that no one can predict the future. Lots of things can go on with the capital markets, with individual companies, changes in management, changes in strategies. catastrophe events, et cetera, that no one can predict. So we feel that the best you can do as a credit analyst is to try to get the financials in as real time as possible, update the modeling, and let your clients know. So that is also somewhat different from the way rating agencies, I think, approach their analysis. And lastly, we think as good risk management type thinkers that any analysis should be measurable and quantifiable. And we have designed, as we may talk about later, a scoring system as opposed to a rating system, which allows a much more exact comparison of companies.
Well, that's great. And I think that leads into the natural next question, and you've already partially answered this, is, what really makes Alirt different from other rating services? You touched on the scoring system, the bottom-up approach. And the thing that I think I'm most curious about with that is, when AM Best or Standard & Poor's assigns a financial strength rating, are they really basing it that much on the parent company?
Our view and our long experience, and I'd like to say up front that we view the rating agencies as peers and not competitors. We do something somewhat differently. They're our colleagues. We know them well. We get their work. So by no means is this a beat-up session on the rating agencies. We really appreciate what they do. But we do believe we have a different approach, and it's our experience that the ratings of insurance companies are generally, we believe, based on the implicit support of a parent organization. And maybe to give an example of this, I'll use someone like AIG, which is a well-known holding company of insurance subsidiaries, both on the life and the property casualty side. What you'll tend to find is that the ratings for all these subsidiaries tend to be the same. And that's because we believe the rating agencies do go in and they get a sense for what the financial viability of the parent is. They obviously set senior debt and often notch the insurance ratings to what that senior debt is, usually 2 or 3 pegs above that. And so if you look at the subsidiaries, say the life subsidiaries of someone like an AIG, you'll find that they all generally will have the same ratings. We take a different approach. Again, as I said, we are really going in and looking at each one of those individual insurance subsidiaries that write the policies that a producer's clients will have exposure to or will write business with. We're analyzing those almost as if they're standalone companies. And then at kind of the back end of our analysis, we roll in who the parent is and what the ratings are that support that. So we just take a different approach to it. We say they take a top-down approach. We take a bottom-up approach. As opposed to the other kind of 2 legs of our Alirt way, rating agencies will tend to have an annual conversation with an insurer and kind of sit down with the management and go through everything. And I'm not saying the rating agencies aren't looking at financials throughout the year, but the ratings tend to have this kind of one-time event aspect, if you will. And that's not bad. It's the way they do it. And certainly if important events happen throughout the year, we can see downgrades and upgrades happen at any time during the year. But by the nature of the way we do things, we're kind of proactively modeling these companies every quarter, regardless of if there's any event. So we think that's very important. And as I said before, the idea of having a score versus a rating allows us to have a much targeted approach towards the financial viability of a company versus its peers. We're really looking at the relative financial strength of one company versus another against a benchmark. I would say a fourth point outside of the Alirt way, if you will, that our model was really set up for us to act as a due diligence staff for all types of organizations. Alirt kind of made its name in the financial institution space, so we today work with probably 95% of the large and medium-sized banks and broker-dealers involved in the distribution of insurance policies. And they have hired us kind of to act as their outsourced due diligence staff. They, of course, have people in-house that do some of this work, but they feel that they can hire our staff, and we have the long expertise, and obviously they don't have to pay our healthcare and all of that. So we really are very hands-on. We have a very different service approach, I think, than the rating agencies have. And, and it's not just financial institutions anymore. We're working with a lot of independent brokers, whether that's BGAs or the retail folks themselves, and we're available to get on calls with clients. We do sit on due diligence committees. We do all of this type of stuff. And again, the rating agencies just really aren't set up to offer that type of service.
Well, definitely. And I think that's important to note. And I think it leads to the obvious conclusion that you need to consider many different sources when evaluating an insurance company, that it's, not just one rating service per se, because each rating service does have their own approach, and that Alirt just provides another facet or way to look at an insurance company. Does that follow for you?
I think it does. I would agree with that. Again, I think folks are using us for a very specific reason. I would say that every single one of our clients is looking at ratings. There's no doubt ratings are still very important. Certainly in the financial institution space, you have a Comdex score and something like the independent brokerage market that is still looked at. And I think people are just looking for some help to go beyond ratings, a Comdex, of course, being an expression also of ratings, looking for a way to get under the ratings, if you will, to see what's kind of going on behind the ratings. And again, because Alirt is doing this work on an ongoing basis, we're able to pick up trends kind of before rating events happen. So I think people are using us for that reason, kind of starting with the ratings and then having us underneath, to provide this extra layer of expertise and insight into what's going on with the insurers. And again, I can't stress enough this fourth element I talked about earlier, that we're also available to communicate with interested parties about this as their kind of outsourced due diligence experts. So if they need to get people on the phone with someone who's buying a large insurance policy, or their trusted advisors, lawyers, accountants, et cetera, we do a lot of that work. So that's nice for folks to have in their back pocket as well.
Well, I think so, and it's the ability to go deeper that I think is what separates Alirt, and that Alirt is a little more dynamic and real time, and I think we see that a lot across many areas. Especially, I'm a real sports fan. I don't know if you're a sports fan, but in sports, it's the advanced analytics. Do you follow baseball?
I do, not at the same level of a couple of my partners who are huge Red Sox fans, but yeah, I'm aware of small ball and all that stuff going on with analytics for sure.
Yeah, and I think this is a similar trend, is that, baseball teams, for example, with pitching, have gotten away from just looking at the earned run average, and there's all these advanced statistics that can really model out much more. Is that it's not discarding the ERA as an important factor in evaluating a pitcher's effectiveness, but they can take a look at many more facets using advanced analytical points. And it sounds like that's a little bit similar to what Alirt does, is that you go beyond using advanced analytical scenarios and analysis.
Yeah, I mean, it's an interesting analogy. I think that, again, we're credit analysts. Credit analysts are kind of the same across the board, right? I mean, our peers at Moody's and S&P and AM Best, Fitch, et cetera, we'll all be looking at very similar financials. Analytics, advanced analytics is obviously a huge issue now, kind of almost a revolution, if you will, and we're seeing it definitely have an impact on the underwriting and pricing and distribution strategies of insurers. But in terms of our kind of day-to-day analytics, we still depend on public information, whether that's statutory information for the individual insurers, whether that's GAAP information for the publicly traded parents. We're certainly tracking all the news as anyone would do, and we're getting the same stuff that other people get, et cetera. So it's really hard to get, and listen, a lot of the insurers that we're analyzing are also clients of ours, especially in the life world. They can share with us information, but in an era of full disclosure, they have to be very careful, especially if they're public, about what they can share with us and can't share with others. So A lot of us are getting the same information, right? And for us, it's really about the methodology, about how we kind of do it. Again, you used a sports analogy, I'll use one as well from football, blocking and tackling, right? We are going out and gathering the information and blocking and tackling and modeling these companies on a quarterly basis. I mean, we're modeling the financial results for about 1,500 property casualty, unique insurers, about 750 life, and probably close to 500 health insurers. So we're doing a lot of analytics that way, but a lot of it's blocking and tackling. And 90% of those carriers are kind of going to be all right every quarter after quarter. Our goal is to kind of screen that universe and find those ones that are outliers that are starting to deteriorate, so that we can communicate that with our clients, and they can be proactive about decisions they're going to make about either business they've written or decisions about continuing to write business with carriers that might be facing some financial issues.
Well, that's so interesting, and I think it adds such a different facet to insurance company analysis. So I think that leads to a good question of what should an insurance agent or broker know about making good usage of insurance company financial strength analysis, either with a traditional rating service company and or using it in combination with the Alirt Research service?
No, I think that's a great question too. We obviously work with a lot of producers, and I think traditionally producers have depended largely on ratings, whether individual ratings or, again, in the independent world, a Comdex score, which is an aggregation of ratings. It's certainly, and I don't mean this to be disparaging, it's certainly an easy approach, right? We can't expect every salesman or marketer to be an expert in analyzing the financial strength of insurance companies. So I don't fault anyone for doing that. And then they're really depending on the expertise of these rating agencies as they depend on the expertise of Alirt. I think one of the things that we've brought to the table is the ability to kind of go, again, this concept of going beyond just providing a letter rating, to having a much more exact approach through a scoring methodology, and also having the ability to call on someone who can help them articulate that. Now, that said, we are believers at Alirt that anyone can become a credit analyst. Now, obviously, we've been at it 30 years, so we're good at it, but we've developed a model, and the Alirt model, our Alirt analysis, which is at the core of what we do, is a 2-page document consisting of a scorecard, which provides the Alirt score, and the second page would be a page that has 45 or so key financial metrics or analytics that go into deriving the score, and those are distributed across 4 tiers of risk that have to do with the investment experience of a company. It has the operating experience, and the last 2 tiers have to do with the parent organization and the ratings, right? It's all kind of laid out there for you, and we have training tools, and we are happy to train anyone who wants to learn how to read an Alirt analysis to be able to do so. And I personally believe, and again, I've never been a frontline producer, so I can be faulted for this opinion, but I do believe that taking some time to understand the basic metrics in an insurance analysis makes you more professional. I think that shows up in your interaction with your clients, and especially if you're dealing in the advanced market, which you're obviously familiar with. You're dealing with high net worth individuals who are buying large life cases or large annuities, et cetera. You're dealing with institutional business where you're selling buy, sell, or other kind of key man products, et cetera. The ability to kind of come in and say, hey, these are the ratings of the companies, but, based on our work kind of going below that, this is kind of what we're seeing. So I do think it helps, again, ultimately in your professionalism and in the way you kind of present yourself before folks. I think the very good brokers I've worked with or producers I've worked with have had a sense that if they've been in the business long enough, they have some scars on their body. They've seen some insurers get into trouble, and they know what that means. So they're much more sensitive to the fact that this can happen. It doesn't happen often, as we know, thankfully, in the life and the annuity world, probably more often in the PC and health world. But it can happen. And, the ability to just be proactive about knowing what signs to look for, I think, are very helpful. We also like to point out at Alirt that Our approach to our work is not binary in that we don't exist just to say a company's is either solvent or insolvent, right?
Mhm.
We like to say there are shades of gray. So when an insurance company starts to get into some financial distress, it may not go out of business, but a lot of things can happen when a company gets into some financial distress, and that can include changes in management, changes in strategy, the sales of blocks of business or businesses in whole. It may mean that you need more capital or surplus in the company, that you get reinsurance deals happening, et cetera. And another thing that can, certainly runoff is another option. The company doesn't become solvent, but it goes into runoff or sells a block of business into runoff. And the service for that business tends to be bad when you're in runoff, right? There's no incentive to service the business well because you're not writing any going forward business. So there are a lot of things that can happen to an insurance company outside of insolvency that can really impact your client. So it's important for folks to know, not just, folks may say, very few companies go out of business, so why even bother? It's really not just about that. It's about knowing what companies are getting into financial distress and what actions can happen when that happens. What other actions outside of insolvency can occur when that happens. And again, that's all part of being a professional and understanding, when you're writing policies, you're essentially writing a promise, and you want that promise to pay off. And if there's any indication that it may not do so, or there may be some stumbling blocks along the way, it's great to know how to figure that out.
Well, and I think that's a super, super important point, is being able to determine, more where the yellow light is rather than the red light. And I know that I've seen that in the life insurance field recently. For example, with Tia Kraft cutting off their life insurance business and what impact that will have on their existing policyholders. Vanguard spinning off their no-load annuity business. The long-term care insurance companies, for the most part, getting out of the business and transferring their business to runoff blocks. I'm more on the life health side, so I have limited knowledge of the P&C side. But however, I know for those of us in the life and health side, we're seeing it and living it every day. And I think it is those things that are going to have a long-term impact on clients.
You bring up a very good point. And it's one of the things that we smile about at Alirt, having been here for so many years. One of the criticisms kind of early in our career was, well, you guys take a real conservative approach. You're going in and you're analyzing these companies, again, at the statutory entity level. And, why bother going in and analyzing, MetLife Investors USA? They're owned by MetLife Inc., one of the largest companies, life companies in the United States. And of course, the parent's going to support this company if it needs additional surplus or financial support. And we've always said that that's likely true, that these companies, obviously, the holding companies have reputation risk issues, so they're not prone to want to blow up a company that they own because who's going to write business with them after that? So that's true, but what we've always pointed out is you never know what the future is going to hold, as I said before. And outside of insolvency, which again is very rare, what we do see a lot of are companies spinning off blocks of business, right? From well-branded companies spinning off their retail operations or long-term care or this or that. And of course, if you're just following ratings, and the rating agencies are largely basing their ratings on the implicit support of a parent, implicit being the operative word here, when there's a spin-off to either an IPO or to a lesser rated parent, the ratings are going to come down overnight, even though the financials of that insurer that you may have exposure to on a statutory entity or deck page level haven't changed at all overnight. There's been no change in the financials of that company. The balance sheet is the same as it was the night before, et cetera. So you look at over the last decade, you look at someone like Sun Life, you look at a Hartford, you look at Aviva, you look at ING becoming Voya, becoming spinoff of retail operations. You look at a MetLife and a Bright House. You look at AXA recently spinning off their U.S. business, retail business in an IPO. You mentioned TIA Cref essentially getting out of life business, which I understand was a small part of their overall business, but it's still indicative of trends we're seeing in this industry where insurers, because I think of the experience over the last 10 years and certainly the blow they took back in 2008 and 2009, have become much more risk averse, especially if you're public. you like to keep the group business, the 401k retirement type business, or the group business where the mortality and the morbidity is very well known, or some of this business is fee business. That's very nice to have. So we have seen insurers getting much more conservative, cutting back on the types of products they're offering in terms of the attractiveness of those products, or in the case of some of the names I just mentioned, selling off those businesses wholesale, whether to another insurer or in the case of several of them into runoff organizations. So I'm not saying you can't trust the brands, but we've seen, I mentioned, I don't know, a handful right there, 6 or 7, very large, well-branded companies that just overnight, and it doesn't happen overnight, of course, but we read about it the next day, decide that they just want to be out of that business, spin the business off. And if you're holding a policy from Hartford or Sun or Voya or whoever it is, the ratings likely are going to come down on those overnight. And it's honestly, where you hold your policy, where you have your legal exposure, may not have changed at all. Our work shows that it hasn't changed at all because our alert score is the same from one night to the next when that event happened. But the ratings, if you're just depending on ratings, the ratings can come down and cause a panic, or of course the Comdex will come down as well. And folks will say, oh my God, what's happened? Well, it may not be a big event. It really just depends on the underlying financial strength of the company that you have written your policy with.
That's great. And that was one of the things that we were going to talk about is financial trends. And I think you have already gotten well into that. Is what other financial trends are you seeing going forward for the insurance industry?
Well, listen, the last decade has seen a historically protracted low interest rate environment. And insurers, I know, as you know, really depend on this investment spread, between obviously the promises they make in their products and what they can make on their investments. They depend on that spread for the profitability of most of their products, quite honestly. Mm-hmm. So in a protracted low interest rate environment, the predicted profits just are not there. And so we have definitely seen that have an impact on insurers. I call it a cumulative trauma as opposed to blunt trauma. If 2008 and 2009, we saw some real blunt trauma to this industry as well as others, a low protracted interest rate really creates cumulative trauma over time. And we've seen that show up we have a composite score, an alert composite score, and we've seen that score drift well below its historical average over the last, probably 5, 6, 7 years without any major recession or capital market implosion. And it really is just because of this inability to make the spreads that they would hope that they would have made, especially on products they wrote a long time ago. Because of this, and I did mention this before, because of the experience in 2008 and 2009 with certain products that quite honestly were mispriced, long-term care being one of them, even going back before that period, and that's well documented why that's occurred. But certainly variable annuities with embedded secondary guarantees that were very rich, probably not with insurers not anticipating we'd have the meltdown we had in that period 10 years ago. They took some hefty losses on that business. It was frightening for them. I think it was one of the things that drove some of the companies I mentioned before out of the variable business, Hartford being a perfect example of one of the largest variable annuity writers. We're sitting in the Hartford area, and it's sad to see, but they had a huge complex over in Simsbury, Connecticut that essentially has been torn down and turned into condos now. It's really eye-opening what can happen to this industry in 10 years. If you had told me 10 years ago that complex wouldn't be there and Hartford would be out of the variable business, and really the retail business for life and annuities, I would have said that's crazy. But these things do occur. So we have certainly seen, in terms of financial trends that occur, we've seen insurers become much more conservative, as I mentioned before, cutting back on all sorts of products, if you will. The fact of the matter is so many variable products were written, and have continued to be written, but were written before 10 years ago that are still in force, that the movement of equity markets still definitely has an impact on the financial of this industry. We can see it almost quarter to quarter. In the fourth quarter of 2012, obviously, we had quite a substantial downdraft in the market performance, global equity market performance. And we saw that have an impact on insurers. It has an impact on the fees they get for the variable business they write. It has an impact on the cost of of some of the derivatives they buy to protect themselves, to protect some of their guarantees, et cetera. So certainly the movement in equity markets is something that we continue to watch and continues to have an impact on the industry. You mentioned long-term care business. That's obviously another financial trend that we've seen. You know, these insurers, I guess thankfully for them, being able to adjust pricing, you know, that's not fixed pricing, they can adjust that going forward, and they've essentially done that in very, you know, in large ways. So that's certainly a trend we're seeing in the industry with long-term care. Obviously, the introduction of hybrid products has been, I think, wonderful for the industry. I'm a big believer in long-term care. I think it's a very important product, but it is hard to buy a product when you don't know what the cost is going to be. And certainly, if someone can change the premium every year, you're kind of going in blind. But some of these hybrid products are nice because you know, the price can't change on you. You kind of know what's going on going in. So I would say that's a big financial trend as well. You know, I talked about insurers becoming more conservative. We have not seen the type of premium growth that you'd expect to see in a 10-year, essentially, bull market. I know the economy hasn't boomed that whole time, but it's certainly gotten stronger over the last several years. And I think that really speaks to the fact that while there's now discretionary income in the pockets of consumers, the products are not there the way they used to be in terms of attractiveness. I don't know if you'd agree with me on that or not, but I think that has put some pressure on the top line of the industry, certainly. But all that said, I would say that the earnings have been decent, even though the top line growth has been difficult. The earnings have been decent for the industry, really, and I would say 5 of the last 6 years, and you can see that quarter to quarter in our work. I think part of that has to do with the fact that, ironically, under statutory accounting, when you're not writing a lot of business, you don't have what we call surplus or earnings strain, and you can actually show some good earnings. Of course, that can't go on forever because likely you have some fixed costs that you're going to need to cover. So the earnings have been decent, and quite honestly, the capitalization for the industry, which is extremely important to every credit analyst, what the surplus level is in the industry on an absolute and risk-adjusted basis, has really been decent and continues to be decent. So there is that cushion, the cushion of surplus, the difference between assets and liabilities, that is still decent for the industry. So we always like to say surplus is important because that's the cushion that allows you to take the inevitable punch, whether that comes, the stomach or the body blow comes from the investment side of the balance sheet in a capital market downturn, or whether you've mispriced product and it comes from the liability side where you have to boost reserves. You have that surplus in your company to essentially live to trade another day, if you will.
Well, you hit on so many great points there, and I think points where we could have another 3 or 4 podcasts to get into the viability of hybrid products and so many other issues there, and surplus and company spinoff and everything else. One of the big things I've always been curious about, and why I was really interested to talk to you on the podcast, is about, you know, icebergs ahead for the industry. One of the things that I know a little about, just enough to be dangerous, are the potential impact of something like collateralized loan obligations, CLOs. You know, are they the new CDOs for insurance companies? Are there other icebergs out there on insurance companies' balance sheets?
No, that's a great question. And, you know, I would say that, you know, if you look back 10 years ago, the problems, I mean, there were obviously a lot of issues, but from an investment perspective, the residential mortgage-backed securities were obviously a major issue. They're not only a major issue for insurers, which are huge investors, they're a major issue for a lot of folks, banks and folks collateralize that, et cetera, et cetera. What we're seeing trend-wise, again, so we're in a protracted, low interest rate environment. And because, again, as I said, insurers depend on credit, on investment spread for their profitability, we have seen what we call reach for yield. And where we've seen that, we've seen a lot of growth in BBB bonds, which are the lowest level of investment grade. So that has been really eye-opening to see that ratio and we always take this as an expression or a percentage of surplus, how that number has grown. So the lower end of investment grade has grown really pretty robustly. The other thing we've seen is growth in commercial mortgages. So instead of bonds, the actual commercial mortgages. This is an area that insurers have been involved with, especially life insurers, for many, many years. A lot of them are very good at it. They have their own teams that do this. It's obviously a great asset liability match for longer tail type products. But we have seen growth in commercial mortgages being written. And we've also seen growth in alternative investments. And these are called Schedule BA investments on the statutory accounting blank. And they consist of things like private equity and hedge funds and, investments in energy type investments, et cetera. A lot of different alternative investments. I think private equity and hedge funds would be a couple of the larger ones that people would be familiar with. While it's still not a large part of the balance sheet investment portfolio of insurers, we have seen that grow as well. So I throw those three out there because you asked me what could be the next, minefields, if you will. Mm-hmm. And I would just say in an economic downturn, you would expect to see some of the following. You'd expect to see the lower end of investment grade bonds either become, get into hopefully not serious credit problems, but, honestly default. But more likely you'd see them drift down and become lower investment grade, what we call fallen angels. So we obviously watch that very closely. Anything that's non-investment grade bonds in a stressed environment would obviously have a greater risk of default. So we obviously are always watching for that. In an economic downturn, you would expect, again, that commercial mortgages would get into some credit quality issues as well, and there'd be losses taken there. It's something that we also watch. What we will say, however, is that back in 2008 and 2009, we were really surprised outside of the residential mortgage-backed securities I talked about, and that the incidence of certainly default on something like a commercial mortgages was much, much less than we had anticipated. Even some of the bond holdings outside of the asset-backed securities and mortgage-backed securities that had some of the problems, the incidence of default on some of the other bonds was not nearly what we would have expected in that type of environment. So I guess what I'm saying is it's difficult to predict exactly what will happen in a stress environment. I think it depends very much on each individual insurer. Obviously has their own risk tolerance and investment strategy. But I think those would be some of the broad, the broad issues that we're looking at, certainly. In a stressed environment where equity markets have a sharp downturn, you'd likely see some issues with hedge funds and equity, if folks who've invested in private equity, et cetera. The life insurance industry does not tend to invest a lot directly in unaffiliated equities because they have the exposure on the liability side through the variable products they're writing. So that doesn't necessarily tend to hit the industry as hard. But some of these other issues, it could certainly come to pass. And we'll just have to see. But again, I like to stress the point that our model is set up almost, our alert analyses are in themselves a stress test, right? Because these are kind of surplus-based analyses, where the denominator in a lot of our ratios is surplus. So we're trying to measure, if this comes to pass, as inevitably will, how much surplus does a company have, essentially to have that cushion to survive those types of investment losses. So it's very important, again, to look even today at what the capitalization, whether on a risk-adjusted or on an absolute basis for these companies are, and to try to work with the ones that are more financially solid, if it makes sense.
Well, that makes perfect sense, and I think that's a reminder to those of us, all across the industry, whether we're directly client-facing or wholesaler or even an insurance company, that you have to take a look at more than one data point, such as going beyond. AM Best is, by far, I would say, the best known rating agency in the insurance business, is going beyond the AM Best rating and thinking what goes into that rating, looking at other financial strength rating services and something like the Alirt Research, and balancing all that out, because it's not a simple question of an insurance company's financial strength. And insurance companies are huge entities with a whole variety of financial components. So, this is just fascinating. So just to move out, I was curious we talked about that you do, you've got a lot of duties at Alirt, directing research staff, managing the IT initiatives, project development, writing research pieces, overseeing business development. That sounds like a lot for one day. How do you prioritize and juggle all those different duties?
Yeah, well, I mean, listen, it is a challenge. Alirt is not a massive company, right? We're a 9-person company, so people have to wear different hats. Obviously, we have some outsourced support for software development and hardware, like a lot of smaller companies will have. But, I'd say that, I've been very fortunate in my career, one, to have two real great partners. We've been together for many years. We support each other nicely. And, I've had the secondary benefit of owning my own company, which kind of makes you want to get up every day and go to work, right? It's, you're kind of, everything you do, you're kind of doing obviously for the benefit of your partners and your employees as well, but also for yourself. So there's that kind of internal drive essentially behind that. But I would say, I like the fact that I'm still, as are my two partners, we're both analysts here. Obviously, we have a team of analysts as well, but keeping your hand in the analysis of these companies is extremely important. As I said, we're a service company, so we are out certainly talking with our clients all the time and on the phone with people who are expert in their respective fields. So we have to kind of have to be on our game, and therefore we have to kind of keep our hand in the analysis as well. So being an analyst obviously helps you when you're out selling and you're marketing, because you can obviously talk about everything that's going on with the industry. But it works the other way as well. I said, having sold and marketed my firm, my partner's firm, for many years, you get very adept at listening. And we always say all of our good ideas honestly come from clients and prospects who say, hey, can you do this? Can you do that? Can you integrate this into your web portal, et cetera? So we're constantly listening and bringing ideas back as kind of the forward-facing salespeople of this organization that help strengthen the analytical side as well. So, I would say I kind of like wearing all the hats. I think it makes us a much stronger company. It makes for a lot of work, but if you like what you do, it's not painful.
Well, that's interesting. I think you hit on, again, some really great points. And I think the most important one is that it's always important to remember that no matter where we are in the business world, is that it's always about the customer and pleasing the customer. That if the clients aren't happy with the product that you're providing, is sooner or later you're going to run into an issue, whether you're an agent, a broker, Hartford, State Farm, you're going to run into that issue. And I think it's interesting that you still touch base with your roots as an analyst, as well as that you're interfacing with clients. I think at a lot of firms, somebody goes into a senior management role, executive position, and they no longer interface with clients. And I think that's a huge mistake, because then you no longer know firsthand what the clients are thinking about, and that's always going to be a separation on a business. You can't best serve your clients if you don't talk to them. So I think that's wonderful, and it's something that we all need to keep in mind as we go through our business. And so as we've talked about, you've been doing this for a while, a few years. Do you have any funny, interesting stories that stick out that you'd like to share?
Having obviously been in this business a long time, obviously involved in a lot of travel, and a lot of that travel has been with my partners. I think there's been lots of funny and interesting times, certainly a lot of times on the road. I will say, outside of funny, I'd say probably my most interesting experience at Alirt of many over the years was on September 16th of 2008. Folks who were in the business then will recognize that was the day after it became patently clear that AIG was facing some very serious problems. They did not get a buyout from I guess a buy-in from some third-party firm, and they did need to get a bailout from the government. That day, my two partners and I literally sat in our respective offices, and the calls came in probably for 10 straight hours, one after the other.
Oh, wow.
Who can get it? The level of panic in the industry at that point, because again, AIG was a very well-known firm, both on the life and the property casualty side, was palpable. One of the things that made the day interesting for us is because of the nature of our work, which is bottoms up. We kept reminding people when they'd call, and these were largely producers calling on behalf of their insureds, with this fear being that, well, AIG is going under, which means our policy isn't going to be covered. We kept reminding folks, who's your policy written with? And the answer would be, well, it's written with AIG. And we're like, no, it's not. Look in the declarations page of your policy.
Mm-hmm.
And you could see, was in the PC world, someone like a Lexington Insurance Company or National Union or, Sun America, whatever on the life side, or American General, et cetera. And we said, okay, so what's the financial quality of that company? Well, we don't know. We just know the whole company's in trouble and the ratings are under pressure. And we said, well, you do know. Look at the alert analysis for that period. And they were able to look and see, oh yeah, it says here that the score shows that there are still well-solving companies. Mm-hmm. And we said, exactly. That's a key here. You've written your policy with a statutory entity. That entity is still solvent. The insurance departments cannot go in. The parent cannot go in, rather, and wholesale take the money out of the subsidiaries, obviously without the approval of the insurance departments, which weren't going to let them do that anyway. So you're okay. And just to see everyone kind of calm down was very professionally gratifying for us, because that's why we're in business. We're in business to help people understand exactly where their exposures are, and to just take a deep breath in instances like that and kind of calm down. But it was a day that, again, I don't think I'll ever forget, just the intensity of it. And again, the ability to help is why you're in business, right? Back to your point earlier. And I think we really were able to help a lot that day.
Well, that's great. So, I think that, my final question is, what's your number one tip rule for success? I mean, you've built up a huge successful company over 20 years. You basically started from scratch with your partners in an industry where there are some really established players. AM Best has been around for well over 100 years. What do you think's been your top rule for success? What's made you so successful?
Yeah, it's interesting. We like it. I'll call it our lunchroom. It's really a kitchenette. People like to put up little sayings or, snippets from articles they've read or books they've read. And there's a couple there that always kind of stick with me. One is attributed to Winston Churchill. I think he says a pessimist sees a difficulty in every opportunity, and an optimist sees the opportunity in every difficulty, right? So I always kind of keep that in mind. The other quote that I like is most of the important things in the world have been accomplished by people who kept on trying. The Churchill quote, I really think, speaks to kind of the correct attitude for success. And the second quote really speaks to the right work ethic for success. So I think if you stay optimistic and you're willing to work hard and keep at it and not give up, I think it's really hard to fail, right? I think those are kind of two keys for success that I've applied in my life and continue to apply, and I do think they work.
Well, and I think those are great quotes to close with. So, as we close, where can people learn more about Alirt Research? And we'll also be putting a link to your website in the show notes. But how can they learn more about Alirt Research?
Yeah, certainly. It's obviously www.alertresearch.com, as you'll see from what you post. I will say that, we are definitely approachable folks here at Alirt. So if anyone is listening to this podcast and wants to talk to me directly or one of my two partners, we are always willing to do that. We're not prima donnas here. So if you want to reach out to me, I'm at david.paul, Paul, at alertresearch.com. And, if you just want to chat about what we do and to see if it would be of help in kind of what you do in your day-to-day life, I'd be happy to do that.
That'd be great. And a quick note for the listeners out there, Alirt is spelled L-A-I-R-T. just on that. And as a closing note is, I've known David for some years and am somewhat familiar with the Alirt Research, and it really is a different look at the insurance companies and their financial strength ratings, and adds a whole new dimension to the insurance companies. And David, thank you so much for coming on the Get Ready with Tony Steuer podcast and sharing so much about what Alirt Research does, where you see the insurance industry going, and about the financial strengths of the insurance companies. I mean, this has been a fascinating thing. So thank you again for joining me today.
Well, certainly, thank you for having me, and I enjoyed the conversation as well.
Great.
I look forward to being in touch.